Welcome to Daybreak Australia. I'm Haidi Stroud-Watts in Sydney. We're counting down to Asia's major market opens.
I'm Annabelle Droulers in Hong Kong, and the top stories this hour. Asian stocks set for a lower open, with the Fed walking an inflation tightrope ahead of this week's US CPI report. Investors also awaiting key economic data from China and Japan.
Australia's budget out Tuesday set to predict inflation returning to target by year-end. Our interview with the Treasurer, Jim Chalmers, in just a few minutes.
Plus, President Biden said to quadruple some tariffs on Chinese goods this week, framing the move as a pre-election defence of US workers.
Take a look at how we're setting up this first thing Monday morning, really. We've got Aussie futures a little bit on the back foot there. Of course, we did have the ASX 200, really a third week of gains there for Australian stocks, really following on the gains that we've seen on Wall Street over the past few sessions, with the data really supporting that Goldilocks scenario. But it is looking like a pretty sluggish setup after what was really ultimately disappointing China data. And of course, that China proxy, always a pretty big heavyweight when it comes to the factors that we look at here in Australia as well. Kiwi stocks already off by about 0.8%. We're seeing Chicago Nikkei futures looking pretty flat at the moment. A50 China futures also not moving terribly much, but we did get really signs of a slowing US economy, in addition to, of course, the weekend data, the credit data in particular, when it comes to China, that signals continuing weak demand. Consumer prices lifting for a third month, but the industrial price side extending that long decline. And of course, front and centre, Bell, is that credit number as well, right? Shrinking really for the first time since April, as we really see that demand side very, very weak in China.
Yeah, certainly a big question as well, given we've had quite a few optimistic good data points coming out of the country as well. But let's take a look at how US futures are coming online this morning, because, as you said, a little bit sluggish, and that was sort of the theme of the session on Friday. We actually really struggled to gain traction here, and this morning you're coming on fairly steady as well. So we've got the S&P 500. It was hovering around that 52.20 mark. Still, though, it did notch its third straight week of gains. That's the longest winning run that we've had going back to February of this year. Treasury 10-year yields as well, they advanced around 5 basis points to 4.5%. And at this point in time, you've actually got a full rate cut priced in by November by Fed swaps. That's what we're seeing indicated there. What else we're tracking, of course, is the outlook for data. And actually, let's bring up this terminal chart here, because ahead of the US inflation print this week, and we can get more on that in just a moment, we actually had the University of Michigan survey coming out here. And what we saw in those numbers is that actually we saw US consumer sentiment declining to a 6-month low, but short-term inflation expectations, those actually picked up. You can see that circle there, and certainly something that does actually perhaps raise those questions around stagflation once again. But let's get more on inflation, because, of course, it is one of the key points in the week ahead. As we said, inflation numbers coming out of the US, and Bloomberg Economics expects April's CPI, PPI numbers to show a marginal improvement from March. It also sees core CPI moderating and the headline figure rising due to high gasoline and food prices. Here in Asia, China is going to be releasing a slew of economic data on Friday, which will probably show a production-led rebound. The PBOC is also expected to keep its one-year MLF rate unchanged on Wednesday, and that will be to avoid further yuan weakness. And Heidi, of course, Australia's government front and centre. We've got that annual fiscal blueprint that is due on Tuesday.
Yeah, and so much of that comes down to the inflation forecast, right, Belle? The Treasurer is forecasting that inflation here in Australia could return to the RBA's target band before the year end. Treasurer Jim Chalmers told us about the government's spending priorities in his only international TV interview ahead of Tuesday's budget.
I think we've got to strike a finer balance in this budget between the near term and the longer term. Also making sure we can provide that cost of living relief for people who are doing it really tough at the moment, at the same time as we invest in a future made in Australia. So it'll be a responsible budget. It will ease cost of living pressures, but it will also invest in the future. And obviously, forecasting inflation at the moment is tricky. It's tricky at the best of times. But what the budget will do is it will put downward pressure on inflation rather than upward pressure on inflation. Yeah, we've made substantial progress here in Australia in the fight against inflation, but it's not mission accomplished because people are still doing it tough. And so the budget will be very focused on that.
Obviously, over the past six months or so since you've been putting this budget together, the outlook for inflation has changed quite a lot. Has that changed your thinking on the way you've put the budget together?
We're making that progress in the fight against inflation. We know that it needs to be the primary focus, particularly at the front end of the budget. And that's why you'll see substantial spending restraint. You'll see our cost of living measures designed in a way that takes the edge off inflation rather than adds to inflation, so that overall our budget will be part of the solution to inflation rather than part of the problem.
Now, moving on to a future made in Australia, that's going to be a big part of this budget. How does the future made in Australia, how does that differ from the IRA in the United States?
Yeah, what we're trying to do here is to make sure that Australia grabs the vast economic and industrial opportunities from the global shift to net zero. And the sorts of things that we are contemplating are not out of place, whether it's in the United States or indeed in most of the developed world. But for Australia, we've got some huge advantages. You know, we've been dealt some incredible cards. Our resources base, our industrial base, energy, our human capital base, our attractiveness as an investment destination. And so what a future made in Australia is all about is not replacing private investment in the opportunities of the future, but attracting more of it. That will require some public investment, and we need to make sure we get value for money for that. We've got our own unique set of advantages as the economy changes, the global economy, and the pace of that change accelerates. We want to make the most of it. We want to create good, secure, well-paid jobs and prosperity into the future. And that requires us to renew and broaden and deepen our industrial base.
But you mentioned, obviously, Australia's unique advantages, but isn't Australia coming too late to this? I mean, a lot of the people we'll be competing against, a lot of the other countries, you know, our partners, have had these policies in place for quite some time.
Well, we better get cracking then, and we will on Tuesday. We have made substantial investments already in our ambitions to become a renewable energy superpower, which is really at the core of a future made in Australia. The global economy of the future will be powered by cleaner and cheaper energy. And we've got a big role to play in supplying that to become a reliable supplier of that energy. But there is more that needs to be done. A combination of tax incentives, targeted grants, making sure that we've got the architecture to attract and absorb and deploy all of this private investment. You'll see a lot of that on Tuesday night.
Now, on to critical minerals, which is part of this. You've announced $500 million so far for exploration for critical minerals. Is that all that we're expecting for critical minerals in this budget, or should we expect more on Tuesday?
Oh, you should expect more on Tuesday. Critical minerals are the opportunity of a century for Australia. This is genuinely a golden opportunity for Australia. Our critical minerals space is one of the reasons why there is so much attention from global and domestic investors. But we need to make sure that we can attract and deploy that. The exploration is an important part of that. That geoscience, open source science to map Australia, our groundwater, our critical minerals opportunities, a big important part of it, but there'll be more.
Speaking of global opportunities, China, we're starting to see a few green shoots in their economy, but for Australia, we'd like to see a lot more, I'm sure. From your conversations around the world ahead of this budget, but ahead of the rest of the year, are you expecting to see more stimulus in the Chinese economy as the year goes forward?
I think there's certainly a prospect of that. Our budget will forecast Chinese growth with a 4 in front of it in the near term. And if that eventuates, that'll be the weakest period of growth of that length since China began opening up in the late 1970s. And so the Chinese economy has been soft. The property sector has been a big part of that, but not the only part of that. And that weakness has kind of offset in our global forecast the strength we've seen in the US.
Australian Treasurer Jim Chalmers speaking with Bloomberg's Ben Westcott there in Canberra. Let's get some views now from Katrina Ell, who's a Director of Economic Research at Moody's Analytics, who joins me now in our Sydney studio. Katrina, always great to have you with us. How do you assess the risk that more lenient fiscal policy within 12 months of an election is going to potentially run the risk of undermining what the RBA is trying to do?
Yeah, I think you've hit the nail on the head with that question and concern. I mean, that's a huge concern for us. heading into Tuesday's budget, because I think we need to really see fiscal policy working alongside monetary policy, and these continued hints of cost of living relief does concern us. I mean, there's no doubt that particular household segments are under pressure in the Australian economy at the moment because of the high interest rate environment that we're experiencing, but at the same time, the Reserve Bank of Australia is deliberately trying to cool the economy, and if we see this budget deliver meaningful cost of living relief that actually adds to the inflationary picture, then it will push out rate hikes, and then it will actually mean that households remain under pressure for longer.
Trina, Ben spoke about, obviously, the huge role that China continues to play in the Australian economy and the outlook. And I just want to throw up one chart, which, we've got a bunch of different charts and none of them are very pretty in terms of the data that came out over the weekend when it comes to credit demand and loan demand. Government borrowing dropping for the first time since 2018. Credit extension, a net drop for the first time in 2005. The aggregate financing contracting for the first time in almost 2 decades. And we're seeing weakness across household demand, corporate borrowing as well. How much of that, I suppose my question is in twofold, how much of that still correlates to what happens with Australia's economy? And is this kind of the reality dawning when it comes to how difficult it's going to be for Beijing to shore up growth?
Yeah, it's a good question. So in response to the first part of your question, I would say that what we're seeing in China is this pronounced weakness, right? And particularly households have been a surprisingly weak segment post-COVID because they haven't been a recipient of meaningful government support. We see that in those high youth unemployment figures and more broadly across high unemployment figures. And so it's not surprising that we are particularly seeing ongoing weakness in household credit, because even though lending rates might have been lowered, there's still not that appetite for credit because they're just so, feeling they're struggling basically. And more broadly, what it means for Australia is that I think that we've seen this really bearish sentiment become the norm when it comes to China's economy, right? So no longer was China that is seen as this, unrelenting growth engine with no issues. Now we clearly recognize within the consensus that China does have these significant kind of structural issues and ongoing weaknesses that it's carrying. There's still obviously signs of hope, and there's still kind of manufacturing and industrial strength, particularly when it comes to these strategic industries like EVs, batteries, solar panels, and that's obviously getting a lot of stimulus and a lot of support, and we are seeing that in the numbers. But more broadly, we do know that China is carrying that weakness, and so it's not this kind of ongoing prosperous engine anymore.
I had to chuckle when the Treasurer said, well, we better get cracking then on, the reality is that when it comes to this sort of made in Australia type policy, other countries have already been doing it for quite some time. How optimistic are you that this is going to deliver as an effective policy?
Yeah, I mean, the jury certainly remains out, but I would say I am in the skeptic camp because we do have a lot of mineral endowments, which is a huge advantage for us. But at the same time, as exactly you point out, other countries have already made these investments, and these investments in improving infrastructure, exploration, they do take time to materialize. And I think because we're so already far behind the ball when it comes to that exploration and building that infrastructure, I wonder whether we will be able to catch up. And at the same time, the cost of capital in Australia is so expensive relative to other places.
And Katrina as well, I mean, one country that's been quite good in this area has been Japan, of course, because they've been really focused on bringing the chip sector, for instance, and reinvigorating that. But we've got the first quarter GDP numbers that are due this week. What are you expecting?
So unfortunately for Japan's GDP figures that are released later this week, it's not going to be good news. We're looking at a 0.1% Q-on-Q contraction, unfortunately. A lot of that softness is actually coming from the household sector. Households make up about half of the economy, and unfortunately, elevated inflation means that wage gains are trailing. So households just don't have money to spend at the moment. At the same time, actually, exports are going to remain a drag on the economy in the March quarter, but at least that'll be a temporary drag that was driven by disruptions coming from the earthquake earlier in the year, as well as some government-related shutdowns to production. So overall, the Q1 GDP figures are going to be weak, and that certainly does complicate the story for Bank of Japan, which does seem committed to continue to gradually pull back on its ultra-accommodative monetary stance.
Yeah, what does it mean exactly for the BOJ? Where do they go from here if we are seeing that weakness coming through, and they've already said that they expect inflation to trend down anyway to the end of the year?
Yeah, so our expectation is that we will actually continue to see kind of modest rate hikes. We've got one more 25 basis point rate hike penciled in for September. And I think that what is a key driver of that rate hike will be that the hawkish stance really that they're delivering and they're clearly communicating is partly aimed at trying to find some sort of floor for the yen, which is incredibly weak. And it's also adding to imported inflation and also adding to the pressure that households are feeling, because if they've got wage growth not really going anywhere yet, and then they've got that imported inflation really, crimping and adding to cost of living pressures, then at least a stable yen might help the picture. So that's, I think, the hope for the Bank of Japan with this hawkish bias that they're really unrelenting with.
Katrina, always great to have you with us. Katrina L, Director of Economic Research at Moody's Analytics. Still ahead, we'll be speaking with the Japanese VC firm Kadan Capital about the challenges they're seeing when it comes to investing in AI and fintech startups in Southeast Asia and across the Middle East. But first, President Biden set to hike tariffs on a range of Chinese goods this week, with EVs in the crosshairs. Those details are next. This is Bloomberg.
Season is here.
This is a get out the popcorn moment.
An across the board just pummeling of expectations.
Earnings matter. That's really clear.
Bloomberg is first to break the numbers.
Hey folks, we've got Microsoft.
Apple earnings crossing the wire.
Alphabet, wow, coming in way above expectations.
Hertz driving in the opposite direction.
A lot still to come.
With the smartest insights.
Meta's kind of damned if they do and damned if they don't.
Is this their iPhone moment?
I view this as Operation Kick the Can to August.
Continuing coverage on Bloomberg. Context changes everything.
Well, the Biden administration is set to significantly hike tariffs this week on some Chinese goods, including nearly quadrupling duties on Chinese-made electric vehicles. Our Chief North Asia correspondent, Stephen Engel, is here with the details. And Steve, of course, it's all ahead of the US election in November and this rising hawkish sentiment. But what do we know so far?
Well, I think the November election looms large on this whole new tariff regime, if you want to call it that, or the hiking of tariffs. But at the same time, they're on products that are not really going into the United States in large numbers right now, right? We're talking EVs, solar cells, and batteries. And also, we heard the earlier announcement of steel and aluminum. Still not a significant amount of the U.S. imports, but very symbolic, obviously, at a time when China is trying to export its overcapacity in these key industries driven by Xi Jinping. It's become a political hot potato, obviously. And I'll get to Donald Trump's comments in just a little bit. But here's, fleshing out this scoop that we had on Friday, where we heard that the Biden administration very likely could be Tuesday, as early as Tuesday of this week, announcing total tariffs on Chinese-made electric vehicles will rise to 102.5%. Up from 27.5% right now. So that's an increase of 272%, nearly quadrupling. Other tariffs will be doubled or tripled in targeted industries, including, as I said, batteries, solar cells, steel, and aluminum. It's not clear yet, Annabelle, which items were spared in this new tariff hike, but sources say there won't be any rate reductions, tariff rate reductions. Biden administration has signaled to U.S. solar industry that they could move to exclude some items, including machinery used to make solar panel components. But again, all of this did not really dampen on Friday, because the story did come out on Friday. The IPO debut in New York of Zeekr, which is the high-end EV maker from Geely. It rose 35% on its debut. It's biggest Chinese IPO since Didi in 2021.
Steve, you mentioned Trump before. Is this sort of an attempt to differentiate his trade policies from Donald Trump? Have we had a reaction from him?
We have had a reaction from him, and he sort of mocked the move and said Biden should have done this 4 years ago, and also warned that the Chinese could be using its plants in Mexico to essentially make EVs, and then through the U.S. Mexico-Canada agreement that Trump did end up signing, then they could export that to the United States. Trump says he'd put tariffs of Chinese-made EVs in Mexico up to 200%. So again, yes, this is going to be a political issue. But as I said earlier, again, right now, the U.S. market for Chinese-made EVs is pretty small, extremely small. And also the U.S., it seems like they are sort of going away from the whole electrification trend in the auto industry. But this is a political issue, no doubt, with the United Auto Workers Union and the like. So this is a symbolic move, for sure, to kind of protect jobs in the U.S. auto industry.
Chief North Asia correspondent Stephen Angle there. And, this sort of shifting of industrial policies and trade policies really, Bell, comes at a time when we're seeing signs of renewed weakness, or perhaps weakness that has, not been quite resolved when it comes to the Chinese economy, right? As you mentioned at the top, it came, the credit numbers that we had over the weekend sort of brought down to reality this idea that because we had a couple of months and a couple of sort of sets of pretty encouraging data, and a lot of it was sort of seasonally distorted, I guess, we're now getting to perhaps the crux of the weakness that we continue to see, which is on that demand side. Be it you talk about household, be it you talk about corporate borrowing, but aggregate financing, that was a chart that we brought up earlier as well, contracting for the first time in almost 20 years. Government financing, net borrowing is negative for the first time since 2018. We're seeing contractions or weakness when it comes to borrowing from households, from bond issuance as well. And so much of this comes down to the property sector. There is another chart that we have as well that takes a look at just the big decline that we've seen in terms of demand for mortgages. Bell, this, I guess, makes it pretty clear-cut how much policymakers still have to do in terms of having their work cut out for them to be able to show up support. Katrina L. from Moody's Analytics was saying earlier, a big sort of chunk of this issue is the fact that households post-COVID have not received that meaningful support for confidence.
Yeah, and we're seeing policy support being expressed in other ways as well. One of the more interesting ones that could take place as soon as this week is China actually removing a possible source of negative data as well, because historically we've actually been able to see on a live basis the trading that was coming through of local stocks with links in Hong Kong. That is actually now going to be scrapped or removed as soon as this week. So China is going to be switching off the live feed of foreign flows, as I said. Instead, that is going to be provided, those turnover details, on a daily basis. Now, authorities in China, they're saying that this practice actually aligns the country with international practices as well, but it is still sort of an attempt, perhaps, to try and stem the impact of data showing foreign funds selling on market sentiment, because intraday readings actually have been blamed for worsening sentiment among Chinese retail investors in the past, Heidi.
We'll also be sort of taking a look at some of the trade implications when it comes to China's partners, right? We've just come on the back of course, Xi Jinping's visit to Europe, these selected countries, including France. We'll be speaking exclusively later to the French President, Emmanuel Macron, about trade, geopolitics, that relationship with Beijing and international investment. That is at 3 a.m. Tuesday, Sydney time. This is Bloomberg. All right, take a look at how we're setting up this Monday morning. We're looking like a pretty sluggish start when it comes to trading here in Asia. Sydney stocks are down about 0.2% in the futures session. We did have 3 straight weeks of gains, though, for Australia, so we're seeing perhaps a little bit of profit taking when it comes to Aussie stocks. Futures in Japan and Hong Kong, as well as mainland China, showing some slight losses as well. US contracts edging low. The S&P 500 really struggled to gain traction on Friday. Consumer sentiment fell to that 6-month low, and short-term inflation expectations picked up as well. So really that Fed challenge still front and centre. This is Bloomberg.
Asia's earnings spotlight shifts this week to China's internet giants. Alibaba and Tencent could report single-digit revenue growth last quarter. That's according to the latest analyst estimates. Bloomberg Intelligence is also expecting slower first-quarter ad growth for Baidu and better margins for JD.com. So that's the big China tech ones in focus. We're also going to hear from Japan's mega banks, which could see a jump in their annual profits. And later on Monday, SoftBank, you can see there as well, probably going to report trimmed losses as its Vision Fund returns to profit. Some of the earnings we're watching there, but as well, as we said, SoftBank, one of the key ones. And let's bring in our tech reporter, Minjong Lee in Tokyo. And Minjong, it seems like we've got some causes for optimism here.
Yes, you're right. We're anticipating some recovery both on the group level and at the Vision Fund. So after posting quite a big loss for the previous year, we do still expect losses, but for that loss to have narrowed quite a bit. This is largely thanks to a comeback in technology valuations across the globe, which has helped the Vision Fund startups to recoup some losses with the recovering valuations. There was also a pretty significant one-time gain from T-Mobile stock options. But yes, a recovery.
Vision Fund has been selling assets. What are the implications for SoftBank?
Right. So they have been selling down quite a bit of their publicly held assets. So looking just at U.S. listed assets, we see that the total value of those assets has been reduced by about $29 billion. So share price declines have impacted the value drop, but the Vision Fund has also been offloading quite a bit of shares in key assets like Coupang, DoorDash, and Grab. So what we're seeing here is a shift in focus for Masayoshi Son as he pays more and more attention to new areas that have greater emphasis on AI chip technologies. And these new strategic investments we're seeing are being executed for the group level and not Vision Fund. So it'll be interesting what happens here going forward.
And is that one of the things that we should sort of be looking out for in the earnings press? What are you going to be listening for?
Right. A lot of investors are paying attention to any details or hints about SoftBank's next big investments because they've been relatively quiet for several quarters. And some people think that maybe there could be an announcement about their new chip project, which would be billions of dollars of worth investments, which we reported about in February. There is also some interest in any potential announcement about PayPay, which could be their next asset to go public. So quite a few things that could come out, but we'll see if there are actually any announcements. We'll have to see.
Our technology reporter, Minjong Lee, there in Tokyo. You can also turn to your Bloomberg for more on this story. TLIV Go for commentary and analysis from our team of expert editors on SoftBank. Not just watching SoftBank, but Japan's mega banks as well, reporting their results on Wednesday. Our Asia investing editor, Russell Ward, joins us now from Tokyo. So, Russell, tell us more about what we're expecting from these numbers and what you're sort of most keenly watching.
Morning, Heidi. Yes, what we're expecting is the mega banks to all post record profits for the fiscal year that just ended in March. But really the focus will be on their outlook for this year and whether they will be forecasting even higher profits, more fresh records for this current year. I mean, the mega banks really are in a bit of a sweet spot right now. Interest rates are obviously finally rising at home. They've been benefiting from higher interest income in their businesses abroad for some time now. They're also actually benefiting from the weaker yen. Look at MUFG, half of its revenue comes from abroad, so those repatriated profits in yen terms are higher. And they're also benefiting from the Japan stock market. Banks have a lot of cross-shareholdings which they are selling and booking gains on those. It's also benefiting the market activity here and their trading businesses. So really, the banks are in a sweet spot. One other thing we'll be looking for is any commentary from the chief executives about the yen and about the outlook for monetary policy, which really is affecting their businesses.
Russell, we've seen so many banks so far in other regions returning capital to shareholders. Are we going to see that profit sharing again in Japan, do you think?
Yeah, I think there's high expectations for that, at least from for Mitsubishi UFJ and for Sumitomo Mitsui. They're probably going to announce shareholder buybacks. Mizuho, it's a little bit less certain for them. Their capital ratio is a little bit lower, so they may hold off this quarter. But certainly, just take a look at the share prices of the Japanese banks. They're all up more than 25% this year. MUFG has a price book ratio of 1 now, which is they've reached the threshold that the TSE is hoping all companies can benefit from, or its shareholders can benefit from. And look back just 4 years ago, MUFG's price book ratio was 0.3. So the shares have risen on a lot over the past couple of years on high expectations for those shareholder returns to come through.
Asia investing editor Russell Ward there in Tokyo. Turning to the latest headlines in geopolitics, the US says Israel risks fueling a post-war insurgency in Gaza, with thousands of armed militants remaining in the territory even if Israeli forces invade Rafah. Israel says it has now evacuated the eastern third of the city as it prepares to expand its military operation. Last week, the US said it would withhold weapons that it may be used in Rafah and cited evidence that Israel had breached international laws protecting civilians. Russian President Vladimir Putin has replaced his long-serving defense minister in a surprise move. Sergei Shoigu had been in the post since 2012. The reshuffle is the first major shake-up of the Kremlin's military leadership since the Ukraine invasion and comes as Russian forces seek to capitalize on a battlefield advantage in that war. Ukraine's leader Volodymyr Zelensky has called on his people not to panic as Russia's advances in the Kharkiv region threatens a local city. He called the situation on the outskirts of Vovchansk extremely difficult after orders were given for a mass evacuation. Earlier, Russia reported multiple deaths after the partial collapse of a residential building it said was struck by a missile. The Philippines says China has deployed vessels to explore a shoal in the South China Sea for reclamation. The nation's Coast Guard said that it sent a patrol ship to what Manila calls Escoda Shoal to deter China's activities. The area is close to the Philippines' Palawan Island, which directly faces the contested waters. The development adds to growing tensions between Manila and Beijing. More ahead here on Daybreak Australia, this is Bloomberg. Well, Japanese markets will open at the top of the next hour. Take a look at what we're seeing when it comes to trading equity futures. And broadly, we're seeing some weakness playing out at the start of trading here. Monday morning across Asia. We're seeing Nikkei futures trading in Singapore looking a little bit softer there after, of course, a weekend really dominated by the weakness in the China credit numbers. Potentially, though, we could see Japan policymakers with a little bit more room to defend the yen if they should feel the need to do so. 155.80 is where we're seeing dollar yen trading at the moment. But there has been, of course, increasing concern on Japan's currency, despite what it looks like potentially evidence of two interventions so far. That rate gap between the dollar and the yen, policy between the US and Japan, still seeing that big gap, right? That June Bank of Japan meeting now considered by investors to be very much live. We had, remember, Bell, those comments from Governor Ueda saying that they would consider a hike. They're very much concerned on watching the impact of the weakness in the yen.
Yeah, certainly something we're tracking very closely there. As you said, we're just continuing to see that sort of slide across the past few sessions, even though we did have those possible two bouts of intervention. But let's get to our next guest, who recently established a venture capital firm to invest in startups covering fintech and AI. Targets include companies across Japan, Southeast Asia and the Middle East, with plans to invest in up to 30 names over the next few years. Joining us from Singapore is Ray Murakami, venture partner at Kadan Capital. And Ray, let's just get started with where you're at in the process of establishing this firm. You have a first fund, is that right? And also, what's the size of that fund?
Right, so we've just announced in March to invest in early stage companies in Southeast Asia and Japan. We have not announced the AUM. We actually invest our own proprietary capital, meaning that we're kind of the VC arm of our family office based out of Singapore. But we plan to invest in about 20 to 30 startups in the coming few years, depending on the macro environment.
Okay, so you have a first fund. We don't know the amount of capital that's been allocated to that, and you're looking to invest in startups. So what's sort of the time horizon here that you're looking at?
Right. So we've just started to invest in, and we're looking to, spend another few years investing and supporting our portfolio companies. But in terms of the timeline, we've already, looking into companies and started investing.
And which sectors are you most interested in?
Right.
Beyond
I think it's
AI
also dependent
and fintech,
on the region.
But which ones?
Yeah.
Mm-hmm.
Right. So especially within Japan, we're going to be focusing more on the B2B SaaS and AI sectors, especially because we see that, the issues with, aging population, decreasing population as a result, decreasing workforce in Japan. We think that these issues will create a huge opportunities for disruptive technology like B2B SaaS and AI, as, Japan has to improve their efficiency and productivity. So for Japan, we're looking into more B2B SaaS and AI, but within Southeast Asia, Southeast Asia can be very different in each country, but especially for Indonesia, we're going to be focusing more on fintech, which will be a more infrastructure that we'll need for the country.
Ray, can you elaborate a little bit more? You've talked a little bit about Southeast Asia. What about the Middle East? What opportunities are you seeing across those sort of markets?
Right. So we are looking into, our main focus in terms of the region is Japan and Southeast Asia, but we also have within the AUM opportunistic bucket where, if we see other opportunities in other market, we would be investing in other markets. And we think that Middle East would be, I think, the third region that we will be looking into. And within Middle East, we're quite excited about AI, especially as the government has, the governments in Middle East has decided to invest quite a lot in infrastructures of AI. And within, Middle East, they have a kind of special, barrier to entry because of the language. So I think for Middle East, we're going to be focusing more on AI.
What sort of returns are you targeting at this point?
Can you repeat the question, sorry?
What sort of returns are you targeting at this point?
Right, yeah. So I think we're thinking to, target about, 3 to 4 MOIC in terms of the return in 10 years. So that would be, more than 30% IRR. But because we are, just using our own proprietary capital rather than kind of fundraising from other external LPs, we will have quite a lot of flexibility into kind of investing into startups for a longer term if that's necessary. So we will be very flexible with, how we keep our portfolio companies.
Ray, just quickly, what sort of size investment are you planning to make here? In each of the different companies,
right,
what sort of
sure.
stage are you most interested in?
Right, sure. So when it comes to the stages, we are going to be investing from seed stage to Series A stage. So that would be about $500K to $1 million into an investment for each company. And that would be the first check that we would invest in. But over the time, if we believe that the companies will grow, we will probably do another follow-on investments on top of that first check.
And are you looking to, it seems like the capital is coming from family investors, is that right? Are you looking to get outside investment as well?
So right now we are just a firm, kind of a VC arm of our family office. So the money is coming from my own family office. So we're just investing our own proprietary capital. When it comes to fundraising in the future, we haven't decided yet, but we are open to kind of, have a long-term strategy to think about fundraising in the longer term. But as of now, we're kind of accumulating our own pipeline and investments as a family office.
The Tokyo Stock Exchange is trying to lure some more outside companies. Would you recommend any of the companies that you invest in to perhaps consider listing in Japan? Can you give us, I guess, your assessment in terms of how you feel Japanese capital markets are at the moment, given the improvements that have been made in governance?
Right. So I think when it comes to VCs, I think we're going to be supporting our portfolio companies in Southeast Asia to be connected to Japanese investors and partners potentially, especially for fintech in Southeast Asia. We believe that Japanese investors has become one of the most important investors. So when we look at the numbers, the Japanese investors actually invested $1.4 billion in 2022 into Southeast Asia fintechs, which accounts to about 15 to 20% of the entire funding into fintech. And we believe that this will continue. The Japanese investors will continue to be one of the most important investors in the region. So one of our unique approach is to connect these, portfolio companies in Southeast Asia to corporates and partners in Japan to facilitate either partnership or, even the market entry into Japan or even, potential exits. So that's one of the kind of unique approach that we do for VCs. And when it comes to corporate governance, I think it's a quite different topic in Japan. But we believe that when it comes to, public market in Japan, we really see that, Japanese public market has been performing pretty well because of the contribution of improvements of corporate governance. Since the TSE has announced to, announced to the listed companies to improve their price book ratio, I think the listed companies has, entered into this trend to really return, shareholders by, increasing dividends and doing buybacks, and the shareholders returning better. Shareholders receiving better return are now reinvesting those profits into the market. So I think this has created really good positive cycle of recycling the money, and I personally feel that for public markets in Japan, that market will stay strong for the next few years.
Ray Murakami, venture partner at Kaidan Capital there. We do have some breaking news crossing the Bloomberg when it comes to ANZ. The bank says that it's cooperating fully with an ASIC probe on a 2023 AOFM bond issuance. They're investigating contraventions of the ASIC Act as well as the Corporations Act. The ANZ Group saying that the regulator is investigating their Australian bond issuance. This after local media reported that ANZ was under investigation by the corporate regulator over concerns that its traders manipulated the sale of government debt last year. This is the second time in a decade that ANZ's fixed income team, according to this report, has been accused of improperly profiteering. We are now hearing that ANZ has made a statement saying that they're in full cooperation with ASIC in this investigation that we're seeing. The probe when it comes to that 2023 AOFM bond issuance is of 10-year Treasury bonds by the Australian Office of Financial Management. ANZ was appointed by the AOFM to act as a risk manager in that case in relation to the issuance of Treasury bonds. The bank saying that they understand that ASIC is investigating suspected contraventions of a number of provisions of the ASIC Act and the Corporations Act. So we continue to bring you more details as they come to us. Coming up, we'll be talking all things AI. The China Show will speak exclusively with 01.ai CEO and Sinovation Ventures Chairman Kai-Fu Lee will be joining us. In Capital founding partner Jenju Scott will also be in that conversation. That's at 11:30. If you're watching in Sydney at 9:30 a.m. in Hong Kong. This is Bloomberg.
Shares of Chinese electric car brand Zeekr gained 35% on debut in New York. That followed an expanded IPO, the biggest US listing by a China-based company since 2021. CFO Jing Yuan told us more about the timing of the IPO amid heightened trade tensions between Beijing and Washington.
We at Zeekr never try to time the market or chase the latest trends. I mean, we follow our own strategies. If you think about overall, say for example, overall Chinese EV market, if you read the numbers in the first half of April, in China, the passenger vehicle market records a new energy vehicle penetration rate of more than 50%. If you look at my pipeline, I've introduced my all-new 111 in February this year, and earlier this year, in 1st of January, started delivering my all-new 777. So my pipeline is also very strong. And if you think about my international expansion strategy, we've been starting selling cars to international markets since last October. And in this year, we're going to sell more cars. So we need this kind of transparency brought by a U.S. listing. All in all, we do think it's a good time. We're not considering about short-time headwinds. We think in long term and trying to make sure that in the long run we make a very, very good business case.
Well, sir, as you talk about how you're expanding to international markets, considering the existing tariffs in place in the United States, the country in which, as of today, you are now listed, and potential that tariffs go even higher, are you now listed in a market that you may never actually be able to enter and be competitive in because of those tariffs?
Yeah, so we are not entering this market, or we are not just listed in the U.S. because we want to enter into U.S. market. We get listed in the U.S. as mentioned earlier. We're thinking about all the transparencies being the U.S. listed public company, all those securities that I receive, and the comfortable I can provide to global regulators that I am a transparent and basically very good global corporate citizen. We think that is actually more important.
Mr. Yuan, the reality check seems to come in your prospectus here, as Zeekr warns investors that the Chinese government could, in fact, intervene in its business to further its own regulatory, political, and societal goals. Sir, why would a U.S. citizen ever invest in a Chinese company right now?
Yeah, so I was thinking about, if you look at the U.S. capital market, it's continued to be a very big, transparent, and probably the most liquid capital market in this world. So being a foreign issuer, we want to see if we can tap this type of markets, and we want to see, we have access to capital at time of need. Again, it's more about my strategy. It's more about long-term view rather than short-term headwinds.
That was a Zeekr CFO Jin Yuan there speaking with Bloomberg's Kaylee Lyons and Joe Matthew. These are the stocks that we're watching when trade opens in Korea, Japan and Australia in just about 5 minutes or so. Watching Honda, the Japanese car maker, forecasting another year of record profit on solid demand for hybrids in the US and two-wheelers in Asia. Also watching Tokyo Electron, that full-year operating income forecast missed analyst estimates. We'll also be keeping an eye on, of course, SoftBank ahead of its results a little bit later as well. The market opens in Sydney, Seoul and Tokyo. And next, we're looking like a pretty mixed start to trading. Some weakness, just modest weakness across the board as we get into the first few minutes of trade. Not much of a carry through when it comes to the lack of conviction in Wall Street. And of course, that slew of disappointing China data over the weekend as well. This is Bloomberg.